let's be very clear about something. For the next 10 years, the rules of the market have fundamentally changed. For the last 30 years, we kinda got used to a world of relative calm, but the very frameworks that created all that stability, well, they're broken. We've officially entered a new era, the Volatility Decade.
To really get your head around this new world, we've got to go back to September 2022. The UK government rolls out a mini budget. A pretty standard-looking package of tax cuts. But the market's reaction? It was anything but standard. The value of British government bonds just cratered with a kind of violence we haven't seen in generations. And this kicked off a terrifying domino effect for pension funds. Their supposedly safe strategies suddenly had them on the hook for billions. They had to start selling assets into a falling market, creating this death spiral that came unbelievably close to wiping out the entire system. I mean, the Bank of England had to jump in just to stop the bleeding.
And that right there is the central question, isn't it? A similar policy just a decade earlier might have caused a few ripples, sure, but a full-blown systemic crisis? No way. So what changed? The answer is that the invisible shock absorbers that used to contain these things and keep markets stable, they're gone. The system has just lost its resilience. To see what this breakdown really means in practice, let's perform a little autopsy on what we all used to think of as a truly safe investment.
For an entire generation, this was the absolute bedrock of financial planning, the 60-40 portfolio. You know the drill, 60% in stocks for growth, 40% in government bonds for stability. It was literally the definition of a prudent, sensible investment.
The beauty of the 60-40 was all built on one simple idea: negative correlation. In the old world, when stocks took a hit, investors would flee to the safety of government bonds, which pushed bond prices up. Your bonds acted like a cushion, a safety net. But that relationship, it's flipped. We're in a new regime now, one that's driven by inflation and supply shocks, where the very thing that hammers stocks, rising interest rates, now hammers bonds at the exact same time. The cushion is just gone.
And look, this isn't some abstract theory. 2022 was the proof. Stocks fell almost 20%. But instead of rising to soften that blow, bonds fell right alongside them by 13%. So a supposedly safe and diversified 60-40 portfolio lost over 17%. That's its worst performance since 1937. This wasn't a fluke, it was a preview of our new reality.
So why did this all happen? What exactly broke those containment frames, those bumpers that were supposed to keep markets orderly in the first place? Well, it really comes down to three key structural breaks. First, governments and central banks have basically run out of ammo. We'll call that policy exhaustion. Second, that fundamental relationship between stocks and bonds has inverted. That's our correlation breakdown. And third, the market itself has just become incredibly fragile and prone to these sudden shocks. We'll call that market brittleness. All right, let's start with policy exhaustion. G7 government debt is projected to soar past 120% of their entire economic output. I mean, just think about that. In the US, the interest payments alone on that debt now match the entire defense budget. The rainy day funds we use to fight crises, they're empty.
Next up, correlation breakdown. During market stress today, the correlation between stocks and bonds can spike to positive 0.80. Now, a correlation of plus 1.0 means they move in perfect lockstep. So at plus 0.80, your safe asset isn't just failing to protect you anymore, it's actively helping to drag your portfolio down even faster.
And finally, we have market brittleness. Those extreme volatility spikes, the kind that used to be a once-in-a-decade black swan event, yeah, they're now happening 4 times as often. The market's ability to just absorb a punch has fundamentally degraded. It's become brittle. Okay, so if the old rulebook is totally useless, what's the alternative? Well, we have to completely rethink our relationship with volatility. We basically need a whole new physics for navigating these markets. For decades, the goal was always to treat volatility as noise. It was a risk you had to avoid or hedge away, or just grit your teeth and endure. But in this new regime, volatility isn't a temporary bug. It is a permanent feature of the system. The new approach, the new physics, is to treat volatility not as noise but as energy, a fundamental force that can be understood and even harvested for returns. So, how do you actually harvest this energy? The key is something called the volatility risk premium, or VRP. Now, think of it like this.
Investors are, generally speaking, terrified of big market swings, so they consistently overpay for protection, kind of like buying insurance for your house. The VRP is the profit you can earn by deciding to be the insurance company, systematically selling that protection and collecting the premium that everyone else is willing to overpay.
And here's the fascinating part. In this new, more chaotic world, this opportunity isn't getting smaller. It's actually growing. Since 2020, the gap between what people expect volatility to be and what it actually is has gotten wider. And that means the premium for providing that market insurance has become even richer. So, okay, what does this all mean for a practical strategy? What does it actually take to navigate and maybe even profit from this new volatility decade? When you really analyze what works across all the likely crisis scenarios, a pretty clear picture starts to emerge. The strategies that survive, the ones that thrive, are the ones built for this new reality. They don't depend on that old stock-bond relationship. They can make money from the size of market moves, not just the direction. And, most importantly, they are designed for volatility, not for calm.
And that really leaves us with a final, crucial question. For decades, the prudent thing to do was to build a fortress and try to hide from risk. But in a world where those old defenses have crumbled and volatility is the new normal, maybe, just maybe, the biggest risk of all is continuing to try and avoid it.